This is a Momentum Media production.
The SMSF Advisor Show. Your expert insights into the biggest themes shaping the SMSF advice industry.
Hi everyone and welcome to the SMSF Advisor Show. I'm Miranda Brownlee and I'm joined by my co-host Aaron Dunn. Hi Aaron.
Hi Miranda, how are you?
I'm good, and yourself?
Not too bad. Foot's already to the floor. I know it's January's but a distant memory now, so holidays and everything, and we are now in February and getting ready. Lots of events going on. Of course, the SMSF Association National Conference, just launched my own SMSF days as well. So not much rest. Seems to be just like 2022.
Yes, it certainly picked up quickly this year.
Yeah, absolutely. And seeing a lot of what's been going on, of course, today's guest, Daniel Butler, talking about the non-arm's length expenditure rules. The government sort of seemed to have got off to a pretty quick rate. I know they're about to reconvene into Parliament as well. But I guess, as we always do, Miranda, to kick off the show, we look at what is making news. So I'm going to hand it over to you.
Yeah, so as you just mentioned, the government has been making a lot of moves in this area. And we just heard from Minister Stephen Jones on Friday. He suggested that this consultation on the objective of super is going to be coming out very soon. So I imagine that might make it more likely that we could see some of those changes on super tax concessions coming out in the May budget potentially.
Yeah, I would almost guarantee that that's going to be the case. I mean, I've seen him now on several occasions talk to the topic of the $5 million cap. Now, whether it is a $5 million cap or something that sort of uses that as a mechanism, we'll obviously need to wait and see. But I guess what he's made clear the whole time is that they do want to bed down this objective of super, and what the objective of super is ultimately going to do is going to say that superannuation is not for estate planning purposes. And off the back of it not being for estate planning, then quite clearly it gives them the mechanism that they want to drive to enable a cap around balances within superannuation. So, the reality is I think this is front and centre. It's kind of typical strategy when you think about politicians that you do see leaks into the media and therefore kind of testing the waters around things. And when you kind of hear the narrative around these things that it's going to impact, only 11,000 people in superannuation, and they talk about the $100 million balances and all these sorts of things, the pub test here kind of says that this is where it's going to land.
Yes, definitely. And we've also seen with the government sort of making these kind of comments, we've also seen a bit of lobbying and comments from groups such as the SMSF Association sort of warning them perhaps not to interfere with the whole transfer balance cap uplift, which is due to happen in July. A few people have sort of pointed out it is a low-hanging fruit for the government, so we could potentially see a freeze, although that is only speculation at this point.
Yeah, so really, now that we've had this confirmation that indexation would jump up from $1.7 to $1.9 million, the natural kind of defensive stroke from within the industry bodies is to say, let's not tinker with super. So let it run its natural course. This is the way the legislation was drafted. So therefore, let it play out as it should. Sure, focus on the high end of town where there's $5 million balances or more, but by and large, this is the framework in which we currently operate. So let it take its natural course, remembering that those that may have already used their $1.6 million when they started pensions don't get any benefit of that change. So there's no personal indexation on those caps. Yes, there's opportunities for contributions, but a lot of those much larger balances have been phased out in the superannuation system already. And that's one of the things that I have a little bit of a gripe about. I don't know if you want to call it a gripe or not, but the reality is the way the super system is structured now, there's really a generation that will work through, and all these problems are solved, because once you get past the beneficiary being able to receive part of that money, these larger balances are all going to have to leave the superannuation system anyway. So I'm conscious that, we don't want governments tinkering too much, trying to fix things with any great immediacy when the system in many respects has been built from this estate planning outcomes point of view. Yes, there are a group of boomers that might benefit from it now, but by the time that money gets to me from my parents, for example, these things aren't really going to play out because that money is going to have to leave the superannuation system. And then any ability for me to get it back in is going to naturally be subject to TSB thresholds and the like anyway. So you don't want the government getting too trigger happy. And I know industry calls for all these things. But yeah, again, we want to see the legislation take its natural course.
Yeah. And the other thing that we've sort of seen with the TBC uplift in terms of lobbying and the pre-budget submissions is perhaps pushing the government to simplify this whole area and allow those people that might have commenced part of a pension or a full pension or their full balance, I should say, to be able to just access whatever the general cap is rather than doing all this personal indexation for each individual's cap.
Yeah, there's a lot of thresholds, isn't there, when you think about it? That's the problem. And I think, personal indexation only makes things more complex, like catch-up contributions, unused catch-up, concessional contributions. It is far more difficult than it needs to be, ultimately, because not only are we managing what's happened in the previous 5 years, we're also managing against a threshold, and that threshold doesn't index, whereas the general transfer balance cap one does. So if we look at 1 July, we've got the disregarded small fund asset rules still at $1.6 million, yet we have a general transfer balance cap potentially going to $1.9 million. So there's an opportunity to try and fix some of these things, I think. And to that point, simplifying a lot of these would be much better. Personally, I believe, that whole unused cap shouldn't really operate. You could probably put a $500,000 cap with a 50 years of age and over and job's done. So there are a range of things that they could try and make things easier to understand in the law, not only for the trustee, but probably the advisor as well.
Yes, it would definitely be good to see some of that complexity reduced.
There is one threshold, remember, Miranda, that is removing, and that's that $1 million TSB threshold for quarterly and annual reporting for SMSFs from the 1st of July, 2023. But that's not really a threshold as such, as we would know with the others, but nonetheless, it is one that is removing.
Probably a good thing that we will be moving to quarterly reporting, given that we will have this, this is another set of indexation, which will make, I guess, another range of different sort of scenarios in a way.
Yeah, absolutely.
And the other thing that we also saw happen in the auditor space is we saw over 374 auditor registrations cancelled. So it's mainly just to do with annual statements not being filed. So it is possible that this was just a case of auditors perhaps trying to avoid the exit fee rather than there being actual, non-compliance issues.
Yeah, and this is a direct outcome of the way that registration process and therefore deregistration was conducted. I mean, having to pay significant amounts of money to leave the system when you could literally just wash your hands of it and then get struck off, in essence, because you don't intend on doing audits anymore, is the reason why we've now seen those changes to the pricing around deregistration moving from, closer to $1,000 to closer to $100 now. So, I don't read too much into the significant number there, just off the back of the fact that it is and more likely that people are going, well, it's not a luxury to have to pay these exit fees just to leave the system. I pay whilst I'm there and I pay when I'm in there. I'm happy to leave the system to let others obviously look after the sector in their own professional capacity. But why I have to pay to leave is a bit ridiculous.
And the other thing that we may see happen soon, which Minister Jones has hinted at, is that we will see the quality of advice review released soon, possibly in the coming weeks. So we should see what the final recommendations were from that and how the government's going to respond as well.
Yeah, and wouldn't it be great to see that published? Obviously, the industry can then start to get their teeth stuck into it. The government doesn't need to make any commitments to it at this stage. I know the opposition have put out a comment that says, they would endorse those changes or recommendations in full to actually help fast track a lot of this. I don't think we'll necessarily see the government take that path. They've got a pretty fine line they've got to juggle between, a lot of the consensual views of the various professional bodies against those views that are being held within consumer groups and the like, which are really trying to uphold a lot of the higher standards out of the Hayne Royal Commission and so forth. So, coming up to conferences, I know both the SMSF Association and ASFA conferences are both on later this month. So to have that information out and available for discussion for professionals, it would be really nice to see the minister get that released as soon as possible so that the industry can have a pretty positive discussion about where we go next.
And we've obviously recently seen the NALI consultation come out. And today we're going to be joined by Daniel Butler from DBA Lawyers, who's going to be taking us through that consultation and sort of what's the reactions been so far after 4.5 years of lobbying. So we'll hear from him now. So we're now joined by Daniel Butler, Director of DBA Lawyers. Hi, Daniel. Thanks for joining us.
Hello, everyone. How are you, Miranda?
I'm good, thanks. We're very fortunate to be joined by Dan today, who's obviously an expert in the area of NALI. So we're going to be discussing this latest consultation. So just to start off, Dan, could you give us a little bit of an explanation about what Treasury has proposed in this paper and what it will mean for SMSFs if these proposals are legislated?
Yes, Miranda, just by way of background, in July 2018, new legislation was introduced. And that legislation had the effect that if you get a lower than arm's length price, I'm going to use the example of $100 discount. Now, let's say it was a related party, and that related party, let's say in this case, an accounting firm, and the accounting firm did the services for a partner or a related party in that accounting firm for that discount of $100, that would then set off this non-arm's length expense. And being a non-arm's length expense not related to a particular asset, all of the income of that fund would be tainted. So let's say you had maximum concessional contributions, you had a cap gain, you also had other income like rent and dividends, etc. All of that income is then tainted at 45%. So that was the effect of the NALI change effective from 1 July 2018.
And Dan, just on that, I think what's important to give context here as well, and you've, I guess, spoken there to the general expenses nature of this. This is really what we're focusing on. And a lot of what the ATO put out in Law Companion Ruling 2021/2, where they looked at this issue, they also looked at specific expenses as well. That part is not being touched here. So the consultation is really predominantly focusing on this general expenditure where we connect it to the total income of the fund.
That is correct, Aaron. And that's the part that the joint professional bodies, there's a whole grouping of joint professional bodies, and there's even a prelim meeting last week. We're all getting together and just getting our minds over this. And look, the general view was after putting in nearly 4 years of effort, we're 4.5 years down the track.
Yeah.
We've had a patch being the ATO's practice compliance guideline. And, good on the ATO. They've been really good. They've been moving with us in industry. However, the ATO practical compliance guideline only again covers you on this general expense. But let's look at the specific expense. And let's take one example, Trang. Trang from example 9 from the ruling. And Trang is a Vietnamese name for an astute person. And Trang is a plumber. So she's a plumber. Yeah. And she goes to fix she's got 2 rental properties in her home, in her fund, I should say. So on the second rental property, she did up the kitchen and the bathroom. Now, I'm sure if Trang knew that when she did that, she would expose her fund to 45%, she would think twice and get advice. But look, one of the problems we've really raised with NALI. And I'm using the term NALI as non-arm's length income while we're focusing on NALI with the non-arm's length expense. NALI being a lower than arm's length amount or no amount when there should be an arm's length amount gives rise to NALI. So it ends up at NALI being the 45% tax rate. But, the example that Trang doing some work would expose all of her fund income, she's, automatically tainted with this 45% tax. And that's one of the biggest issues that the industry doesn't like. The industry was really calling on the government to say, we need a total overhaul. This provision, non-arm's length income, was introduced in the 1960s, and that was when there were some fairly aggressive schemes around. And the case law here, there's cases where the purchase price of the shares in the company, it was 1/10. That was Darrell Lynn, and that was a federal court judgment in 2010. Then GYNW, a tribunal decision in 2019. And even there's a very small token of investment of a couple $100, which produced over about $1.8 million in a matter of 3 years. So, and we've had other, what I will refer to as scheme cases that have really given limelight to what NALI is about when you get to schemes. But when we got the ruling, when the ruling issued, we're talking about, hey, there's this discount, and typically it was an advisor fee or something associated with that. And if we look at the average advisor fee, what it might be between $1,000 to $3,000 a year would taint the entire fund.
And do you think there is any sort of appetite from the government to look at some of those other issues outside of the general expenses, or it's likely just to stay limited to that issue at this point?
Well, there's firm resolve with the joint professional bodies, and they have been very consistent and persistent with their view that the specific expense item also has to be addressed because, look, it could be a small discount on that front end of the acquisition, which that asset is then tainted again for life. So it's not only the rental income, it's also the capital gain in the future. And one of the real aspects here that can also get involved if it's not a specific asset is really, as I mentioned, concessional contributions. But concessional contributions is on the table now with the general expense, but with the specific expense, it's the disproportionate amount of tax that can be paid.
So, Dan, I might get you to explain to our audience, I guess, the concept that's been proposed here, where we're looking at this factor, in essence, that is grossing up and therefore creating this amount that would need to be included as NALI in a particular income year.
Well, yes, Aaron, and the consultation document gives a number of examples. And example 1A, the brother is doing the fund accounts and there's a $5,000 discount. So that $5,000 discount is multiplied by 5. So there's now a $25,000 amount, which will be taxed at the 45% rate. So in effect, what Treasury say, that's a 225% tax rate on that discounted amount, being the brothers not charging for that $5,000 of accounting fees. It's a 225% tax rate to provide that disincentive for not encouraging that activity.
So is this factor ever a factor in the discussions, I guess, that you've been involved in over time? I mean, I know there'd been discussions about shortfall components and other things, but has this kind of come out of left field, or is it sort of been in the narrative at some point in discussions?
Look, really, to most of the people I've been speaking to within the joint professional bodies, it is out of the blue. So it is a new concept. It might have been within very small circles, but the general theme was it wasn't on the agenda. Our concept was starting with the excess amount. Mm-hmm. So really, when we talk about a 5 times multiple, well, why do we pick an arbitrary 5?
Yeah.
Why shouldn't it just be 1? That's the starting point, because on top of the 1, we have the penalty regime, the normal penalty regime. We're talking tax here. So we have the normal, have you used reasonable care? If not, more than 50%. Mm-hmm. If you haven't used reasonable care, there's 25% penalty on top. So I like to sort of work with what we have had in the past and what people, particularly tax practitioners, are accustomed to, with that system.
And what do you think was the rationale behind these rules applying to SMSFs but not the APRA funds?
Look, they do go into that, and they actually in the Treasury do mention that the primary intention of reducing costs and passing on savings to members is what the large funds do, rather than being the dominant purpose of obtaining a tax benefit. So in some respects, self-managed funds are being castigated. They are getting the short end of the deal, because going into it, the joint professional bodies were quite firm. Look, we stand together. Large funds and small funds, we stand together. And some of the large funds were saying, we want this as an integrity measure. So look, the joint professional bodies were very straight here, really working well with the ATO, working well with government and Treasury. And they say, look, we know there needs to be some integrity measure. All we're asking for it is to be proportionate, fair. Like, let's take Trang. If she fell into the trap not knowing and it was honest and inadvertent, give Trang another go. Let her pay a bit of tax now, but don't taint her property forever type thing. So we needed this opportunity to rectify. And it should be in that context of that early engagement and voluntary disclosure. Let's encourage people to come along.
Yeah. I think that makes absolute sense. When you look at it it appears very black and white. So you identify the shortfall, as the example is, and then you just apply this factor to work out the application of the non-arm's length income rate of tax. Whereas I think absolutely what you've said there, Dan, is correct, that there needs to be some kind of middle step, doesn't it, to say, because in Trang's situation, certainly it may not have been the intended outcome. And yes, if there's kind of enough rope, so like a voluntary disclosure does do, and they make all the right endeavours to try and remedy this and therefore not do it in the future, well, then there should naturally be an avenue to do so.
Correct. And then the 2018 consultation document was about low and no interest limited recourse borrowing arrangements. So industry participants and advisors, and I'm sure you are well aware of this too, Aaron, there were a couple of positive private binding rulings that set off that low and no interest loan arrangement. And therefore, it did flourish a bit. But look, if people went to sound advisors, we were saying, no, that's got risk associated, don't do it. So the good advisors were saying, don't go there. And those that did it without a PBR were at risk. They cleaned it up at the end of 2016, and provided you had your LRBA on arm's length terms from 1 January 2017, you are A-OK under NALI. And in fact, they brought out a supplement to the ruling. The ATO did bring out a supplement to the ruling to say, look, even though there might have been low interest before that January 31, 2017 period, you were A-OK, provided from the date of that prior PCG 2016/5, if you were then on arm's length terms back then and paying monthly, you're okay. But again, someone falls off the track a little bit, like there's a month or two in delay, dang-o, they're back into NALI.
Yeah, and it's permanent.
And it's permanent. And you've tainted that asset, and you may have held that asset for 10 years. You may hold it for another 10 years, and you're going to get hit up at the end. And what we tend to find here with NALI is if you do well, the ATO is going to come to you, knock on your door and say, hey, congratulations, you've done quite well here. Yeah. We want to know. You've got 28 days to prove to us why this is not to be taxed as NALI at 45%.
And that raises an interesting thing in itself in terms of where that disclosure of that discount or whatever it may be will get picked up, because, is it going to form part of the compliance administration piece? It doesn't necessarily fall into the jurisdiction of auditors. So therefore, how are these things going to potentially get wrapped up to determine where this factor-based approach or wherever they ultimately land is going to be? Because it may come back to the ATO in part of their due diligence of funds and compliance activities to say, well, yes, as you just rightly said, you've got 28 days to tell us why that should be tax exempt or 15%, but should be 45 instead.
Correct. And the thing is here, what we're getting is more responsibility on advisors and more responsibility on auditors in particular. Like auditors now have to start asking, hey, you got a well-stocked tool shed. What are you doing the weekend? Are you down fixing that rental property that's owned by your self-managed fund? We want to have a timesheet of what you did on the weekend or after hours. Look, Trang, if you're calling by your rental property, we want to know what you're doing.
Yeah,
So
and you know how well that goes down, don't you, with some of those tradie clients too?
Well, exactly. And it's funny because, there's far more accountability. Everyone will pay more for administration. So your cost of administration go up, the cost of audits go up. And it's really over, something here. If we do bring in an approach like where Treasury is going, look, as I said, Treasury is really trying to narrow this to NALI. The joint professional bodies are trying to open it up to NALI overall and to tackle those other harder issues, because that's what's needed here. It's a proper review and a proper chance to look at old legislation and fix it. It's really broken. We need fairness. We need proportionality. We don't like the fact that it's automatically invoked. We would like to have the commissioner must make a determination, because unless the commissioner makes a determination, advisors have to be on the aware, and auditors checking here, there and everywhere. Give us your timesheet on the weekend and after hours. Show me your tool shed. They haven't been used on your rental property with your super fund and so on, because it gets into nonsensical detail, particularly, as I said, when this was introduced, it was for those arrangements which we all knew had to be dealt with, like LRBAs, low or no interest.
Yep.
No one has an issue with that. No one has an issue with the overriding integrity of the system. We don't want the system to be gamed or exploited, but we need fairness there. And when we start talking about like $1,000 or $100 or $3,000, which could, literally cause you a lot of tax, that's when it gets, really out of hand. And we really have a conflict situation here. That is the ATO standing in a position of conflict. They have to enforce the prudential regulation rules of, in the SIS provisions, but they also are the tax collector. And invariably here we have the tax people of the tax office collecting on NALI, whereas the other side of the ATO with the super division, who generally have done a very good job, but we have this inherent conflict. Look, will the ATO chase NALI first, or will they chase a SIS issue? Because NALI will bring home tax, whereas SIS won't necessarily bring home tax.
Yeah, absolutely.
You mentioned before that the transitional relief in the PCG 2020/5 is going to be expiring soon, and it's probably not likely that these changes will be legislated in time. Do you think the ATO will be willing to consider another extension of that?
Look, I'd hope so, Miranda. They have walked with us in industry so far. As I said, it's 4.5 years have ticked by. I'm sure Treasury would be probably attempting to push this through to have any chance of getting it into the May budget. However, as I said, we've been given a very short consultation period until the 21st of February. Really unfair for a measure like this. This is a really big issue. And I don't like, this is a major industry to our economy, and trying to deal with this. And it was really most of the people that I spoke to were really offended of the amount of work, the amount of time that the top professionals in Australia in this area, some, top tax lawyers, they've been QC input, barrister input, top advisors from all of the large accounting firms and medium and small firms. And they've put a lot of effort and really trying to do the proper job here over a long period of time, and we come out with this. So there's a real disappointment as to what we have been served, and we would hope that Treasury would really take on board all the effort to get this system right for a very important part of our economy and world financial position.
And I think from the messaging that you just said there, I would expect some of the responses to this consultation will probably be reflective of some of those views as well.
We can only hope.
So, Dan, I guess, is there anything else from this? Of course, as we've said, we've been talking about this for some period of time, not only on this show, but obviously more broadly. But from this specific topic, is there anything else, I guess, the professionals need to be knowing about or potentially be doing and preparing their clients for as we move towards 30 June?
Yes, there is, Aaron, and that is really education piece, and that is warning clients about the dangers, making sure they are alert to these issues of related party dealings in particular, where NALI or NALI could be invoked. The one point we didn't discuss, which I'll just put on just before we finish up, and that is the 5 times multiple. There's one example, 1A, which we went through, which was 5 times 5 to get you to 25. Yep. but the fund's income for that year was well above the 25,000 mark. Whereas in example 2, the income is capped at 20. So the 5 times 5 would exceed the 20 being the actual income. So the NALI that is taxed is capped at the level of income being that $20,000. So the tax is then capped at that 20,000. So there is a limit, but still what I'm saying from a practical point of view, advisors need to be on the alert for particularly specific expense NALI. Now, the specific expenses, and one of the other things we didn't discuss is, look, valuations have been hotly contested in numerous areas of tax. Yep. There are going to be other areas of contestation given the rules and this distinction between specific and general. That is, okay, let's talk about an accounting fee. Let's talk about an investment advisory fee or a legal fee that is a general expense. Let's now drill down on that. Was it really for the general fund, or was that for the implementation or the acquisition of a particular asset that the accountant or the investment advisor or the lawyer worked upon? Those are the types of disputes that will arise. Now, I've been a tax practitioner for well over 30 years, hence all the grey hair. And I know fighting the tax man is a hard gig. Why? Reverse onus of proof. So the taxpayer has a reverse onus. Not many taxpayers have won ever in a NALI dispute. There's probably one that I could talk about, but that was not really a full win. But it's a hard gig to win. And the cost, the time, the anxiety, and the wear and tear you have to go through to defend a client is huge. So be prepared, because these matters, which may involve about $3,000 of NALI or NALI, you just pay the tax. It's not worth fighting it. Yeah. And that's the silly thing. And we know the ATO, being practical, hopefully won't go down to these smaller amounts. They're after the big ones, but still it can be applied at the smallest occasion, even a $1 discount. So we would want some sort of de minimis in there, whatever comes through in the end.
Yeah.
Well, thank you so much for joining us today. You've given us lots to think about. And we should also mention that you'll be speaking about this topic at the upcoming SMSF Association National Conference. So if you want to hear more details about this particular consultation, you can hear from Daniel Butler then.
Yeah, and I look forward to seeing as many of you as possible at that conference. We're going to have a really good time.
Yeah, it's going to be great. So, Dan, thank you once again. Your insights into this topic, certainly not only appreciated by Miranda and myself, but to our audience more broadly as well. Thank you very much.
Thank you. And we just want to get the right outcome for the industry here.
I concur 100%.
We deserve it.
So, Miranda, it's always great to hear from Dan, and obviously his insights, being so closely involved and attached to this topic, is always fascinating to hear. So from your point of view, what was the key messages that you got out of our discussion with him today?
I guess it was interesting when he mentioned about it potentially leading to more disputes about these kind of issues, and how it'll be really important defining those specific expenses. But he also sort of highlighted that there's sort of other issues that haven't been addressed with this consultation as well, like to do with the specific expenses rather than the general expenses that people still need to be really conscious of.
Yeah, so to me, again, I sort of agree with that, where the brief or the scope appears to be quite narrow in the consultation, and from the working party, let's call it, of the various associations, both APRA, SMSF, accounting bodies, legal profession, and so forth, there is really an appetite to look at this more broadly than that. And you could kind of hear from Dan the level of disappointment in the timeframe for consultation as well, and the fact that it's almost come out of the blue, this factor thing. We've heard lots of ideas from within industry about which way the government could go here. And yet here we have something that just applies this kind of arbitrary number. And yes, there's some methodology that sits around it based upon, maybe the level of income being lower than that factor of 5. But, the reality is it doesn't feel or appear like there has been anything included from a lot of the consultation and discussions that have been going on.
Yes, it was a bit surprising, so I think, what came out. But I suppose they did say in the paper it was just a starting point, so maybe it will take a different direction. We'll see.
Yeah, well, it's kind of like what seems to have happened for 4.5 years with this topic. So maybe they're just staying on song in that regard. But anyway, let's just fingers crossed we get the right sort of outcome and we get it sooner rather than later that enables us to get more certainty on a topic, like I said, that's been hanging around for some time. So as is always the way, Miranda, if people have got any suggestions for topics, speakers, or things they'd just like to hear about, how can they get in contact with us?
So they can get in touch with us at editor@smsfadvisoronline.com.au.
Excellent. Well, thank you once again for joining us for the SMSF Advisor Show. Our next event, I think, Miranda, will be from the SMSF Association National Conference.
Yes, we'll be there live recording again this year, and we're hoping to speak to a whole range of different speakers that will be there at the event.
Excellent. Thank you, everyone. Have a great rest of the week, and bye for now.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Imagine being rushed to hospital.
Yep.
And your life changing in an instant. Imagine going through hundreds of tests and 46 weeks of chemo. Now imagine you're a child. That's why Starlight exists, to bring happiness to seriously ill children. Please donate at starlight.org.au.